Hello, very good evening, everybody. I Let me just take a look. Okay. Hi, everyone. Welcome to our third session of our ASEAN Investment Challenge webinar. I think maybe we don't call it a webinar, we call it live. Anyway, for those who do not know, I'm Billy To. I'm the head of retail regional research at CGS International. So I have more than 10 years experience covering markets from Malaysia, Singapore, Thailand, as well as Philippines. I think for the MIST region, I think I only didn't cover Indonesia, right? So today our topic will be a bit more on how to automate your investment. It's going to be very practical for your long-term investment, especially if for investors who are just starting out and are not very familiar with how to trade and how to invest. All right, before I start, let me just share my screen. Okay, see, see that? Okay, so today's topic will be on easy investing. Set it, forget it, and grow it, right? So basically, we're trying to simplify investing, especially for investors who are a bit more cautious and uncertain on how to trade or how to make trading strategies, etc. Right? Okay, just a disclaimer. This is not an investment advice. It's basically an education and awareness that we intend to help you guys to understand better in terms of how to get your investment started. All right. Just a quick recap on what we've done over the last two sessions that we have. I think the first thing, probably the big one, would probably be that I think we've managed to we've managed to address one of the key issues that I think a lot of people have, especially for investors who are just starting out, is that you really don't need to be rich to start investing. It is about, investing to get rich. So just to put into context, I mean, recently I've been on this TikTok live to see how the Gen Z are communicating. And I realized this one thing is that a lot of Gen Zs are afraid of getting involved in investment because they felt that it's for the rich. And a lot of time they look at other asset classes like cryptos and all that that allow them to invest at a very low, with a very low startup because you can invest in fractionals in terms of the cryptos and all that. I want you to know that it's a lot very similar even in the traditional investment market, like your stock market. So this we will talk a bit on that later on in during the session. So the last sessions we have, we talk about how to manage risk, and one of the key thing is how to position yourself so that you can invest in the long run. I think we talk a lot about emotional traps, how you want to manage that risk smartly, and to build a solid defense through diversification as well as the right mindset for long-term investing. Okay. So before we start, I'm just similar what we have. I guess you could probably just list down what you think on the comment sections, right? Basically, just a pulse check. Like basically, how many of you really check your portfolio, more than you look in your IG? I'm sure that those who are investing, those who are trading, they look at their trading portfolio very often. So it's fine if you're looking at it every now and then, especially when you just started trading and investing. And then the next thing is if you were given $1,000 today, right? What would you do with it? I think that's very important. Some people look at it as YOLO into meme stock. They wanted to get rich quick and they wanted to look at stocks that can fly very quickly. Some people probably just want to save for the next iPhone or whatever next purchase that they're looking at, right? Or maybe you just, like what we talk about in these sessions, just invest it and forget about it, right? And then, or some of you probably just like to eat or drink or party, so you probably go into that. So just look at that and see that kind of characteristics that you have, because that will help to decide what sort of investment strategy will really fits into your portfolio in the longer term as you start your investment in a more into the mainstream, especially a more traditional investment tool. All right, so why does investing feel so hard for a lot of people? I think this is quite important. I think a lot of us have that difficulty, especially when we start investing. We felt that it's quite difficult to get into it. There are a few reasons for that. I think common concerns are people do not have the time to monitor the stock market daily. I'll just give you an example. The Mac 7 have been releasing their earnings this week. So if you are really looking into it, you have a tough time because Microsoft was releasing their results, Apple was, Meta was doing it. So there's a lot of different results that are coming out. Not only that, at the same time, you have your US Federal Reserve meetings overnight, right? And then there's also tariffs that Trump is talking about now with India and things like that. So these are all things that move the market. So a lot of people really don't have that capacity to look at the stock market on a daily basis, right? Unless, of course, if you're in my career path, then it's a bit different because I'm looking at it on a daily basis, right? Or some people are just afraid of losing money because you've never tried it before, right? Or maybe you have tried it and you got burned, so you're a bit afraid to look into it. Or maybe you just don't know how to start, right? You don't know which platform to look into and stuff like that. So a simple idea that we've introduced is that we talk about is how do you invest without all these stresses? Basically, you set it, you set a certain investment amount that you wanted to invest on a regular basis, and then you just forget about it and let it grow in the time, right? So you can see instead of trying to be the person on the left, right, you basically just set it and forget about it, right? Okay, so let's just look at how this can be done, and we call this, or I call this the easy peasy drill. Basically, the three ways that you can really get investing started in an easier manner without the stress. Now, first strategy is really, I think we talked about that as well on a more general basis at the earlier stage. I think we talk about dollar cost averaging. I think that's one of the easiest way for investors to get starting. Then the second one is probably a bit deeper, index investing. So there are a few ways to do that for index investing, right? You can actually do it through your funds, or you can do it on your own by buying into index funds like ETFs. So I'll just briefly explain some of that in a later period. Right. Then, of course, the last one is what we call regular savings plans. And I can share some of the platform that have this feature. There are actually a lot that have these features nowadays. Now, so what do I mean by dollar cost averaging? I think we talk about that. Basically, it's just investing a fixed amount of regular intervals, regardless of the market price. So this actually helps you to reduce timing risk. It smooths out volatility. So, for example, I think January to March, the market was doing pretty well, especially in the US, right? But then April came, and then Trump announced the tariff level that is at a very extreme level. Then the market tanked by about 20% plus, over 20% to 30%, right? So if you've been investing at a regular basis, on an every 3-month basis, or every 2 months basis, or monthly basis, you'll be able to tap onto the market swing. So when market is on a high level, you'll probably be buying it at a slightly premium. But when market drop by about 20%, you're actually buying at a good discount level, right? So it's basically like, when you go shopping in your favorite grocery store, sometimes there is discount, sometimes there isn't, right? But if you buy on a regular basis over the long term, your cost would be averaged out. So that's basically what dollar cost averaging works, how it works. The idea is, of course, because the market, like as we talked about over the last 2 sessions, the market in the longer term basis usually move uptrend, right? So the next one, index investing, I'll spend a bit more time on this. So basically, the idea is that you wanted to buy the entire market or the entire index rather than just choosing stocks. So not a lot of people are able to follow stocks like what we talked about earlier, right? Microsoft has their news release, Nvidia is coming out with their release. Then, of course, Tesla has their results that were underperforming, underwhelmed, right? Then there's other news that affect different industries aside from the tech sectors. For example, the pharmaceutical. I think just the other day, some of the Chinese stocks actually collapsed quite a bit because of some news on the pump and dump. There's a lot of concern that there are too many speculators in the market. So these are just some of the things that investors need to pay attention on, right? So not everyone have that capacity to look into this kind of market swing, especially if you have your own commitments at work and your studies as well as your own dreams to build up whatever career that you wanted to. So this index investing allows you to do that. So most of it are low cost. Most of it helps you to diversify and time tested. What I meant is that, so for example, instead of trying to guess the next Tesla or the next Microsoft or the next Facebook, for example, you just buy the entire S&P 500. So basically the S&P 500 are the largest 500 companies in the United States. So what you do is that you buy the entire index based on the weightage that there is, and then your funds will go into that particular index on whatever, say you wanted to invest in the ETF on a half yearly basis. So that's what your funds will do, right? That basically invest into the ETF. So ETFs are usually cheaper because the cost that comes with it is probably the lowest in the market that you can find. So that's very good in terms of how you want to build your portfolio. It helps you to have an instant diversification, right? Instead of trying to find the best companies, you automatically invest in the current best that there are in the market. So of course, on and off, you will have, the bear market where the S&P 500 tank like 10, 20, 30%, which goes back to the DCA that we talked about earlier. When you combine both, this is actually a very good bulletproof way to build up your wealth in the long term, right? So aside from ETFs, there are other ways to do it. Is you probably can buy through funds. So there are funds that actually help you invest into index as well. So for funds, usually it's more active. So there will be a fund manager that manages your fund, right? So there will be a certain allocation for different markets based on the fund mandates that there are. So usually the costs are higher because it's active investing for the fund managers. So it depends on what you're looking at. So I guess my advice is that for people who are starting off, go into ETFs because that's automated, that's passive. You don't have to be actively looking into it. So as you build up your knowledge in investing, right, that's when you can start to diversify and expand your horizon. Now, the third one is the RSP that I talk about, regular savings plan. So what it means is that it's basically a savings plan, right? What it does is that instead of trying to time the market, you invest it on a fixed amount regularly into ETFs or stocks. It's very similar to the first two that I talk about, but instead of doing it manually, what it does is that you automatically do it, right? So what you do is that you set it in your bank, and then it will do it on a regular basis. Say every 6 months, your bank will just invest $500 into or $200 into whatever markets that you are interested in. So this is basically to help you to avoid having that emotion, because if you don't automate it, a lot of times what we do is that you have the tendency to look at the market and try to beat it and think that, okay, maybe I don't invest now, maybe I wait until the market fall by another 10%, then I jump in, right? So this RSP is basically helps you to avoid that. So I know there are a lot of markets, so I'll just give an example. If you have friends or families, people or relatives who are doing insurance, so a lot of time they will talk about investing in savings plans, right? Stuff like that. So those are similar. The RSP that I'm talking about is similar to that, but the return for RSP, when you're doing it on the stock market directly, the return is usually higher, right? So there's a difference between the insurance ones and the one that I'm talking about. So this one has a lot focus more on the return. So it allows you to automate it. It's convenient. It's easy to do so, and it helps you to build the discipline. So you can see the image here that I'm showing you is basically the platform that we have at CGS International is called SafeUp. So for those of you who are joining, who are AIC participants, you can actually get a promotion now. So what you do is that when you open an account with the promo code AIC 2025, you get certain enjoys commission-free buy trades, as well as getting a certain worth fractional shares of the S&P 500 worth $20 US dollars. So this is easy way for you to get started, right? You can scan the QR code and then you will actually be able to go in there. So this is basically allowing you that platform to do so. Aside from us, there are other platforms that have, for example, Robinhood and the like. So a lot of other platforms are also offering that. So the idea is basically allowing you to be able to build that portfolio easily without having to trick or trying to beat the market or trying to allow your emotions to take control, right? Okay, so why it works, I think it's a lot similar to what we've talked about over the first two sessions. If you remember, we talked about compounding, right? So this is actually the similar charts. If you look at Anna, Ben, and Chris, right? So when Anna started investing at age 20, the value of his investment the value of her investment by the age of 65 is significantly higher than what Ben and Chris have, right? Bear in mind that all three of them would have invested $100 on a monthly basis, but the return is significantly higher because of what we call compounding. Because when you compound your earnings on earnings, so the return will be higher, right? So that's basically why it will work. Because when you allow your money to work for you, you don't have to be, you don't have to fight on how or what's the best way to look into it. Now, the second thing is because discipline will overcome that emotion portion. I think we've talked about emotion on a lot about how the emotional how it moves as the market moves, right? So this allows you to avoid getting into a panic mode or allow you to being too greedy for more, allowing you to be able to focus on building that portfolio on a consistent basis. Right. And then, of course, then you don't have to be a professional. Not everyone have the time to look at the stock markets. You probably don't understand what Palantir is, for example, right? Some of you might know what Microsoft is, but Palantir might be new to you, or maybe you don't know what some of the pharmaceutical business structure or how the IP business work, right? So those are things that you probably don't have time to get into. So it frees you from that, right? You can actually invest freely without having to deep dive into all these structural or business fundamentals in terms of for each company. Now, but what if the market crash, right? Now before I jump into that, let me just quickly take a look. I'm gonna all into okay, so I think again I will probably say that I think we've talked about that in risk management previously. I think going all in is not something that I would have encouraged. I think it's always about balancing. So I would say that if you think that say for example, if you're convinced on goals or whatever, right? What you do is that you probably want to allocate a bit more on commodities, because commodities, stock market as well as bond, they move in different direction most of the time. They won't move in line. And so when you have that diversification, it allows you to build a portfolio that is more resilient. So let's say if suddenly there's a bull market or whatever, right? If your goal is to correct at a certain level, then it allows you to balance that up and down swing in your portfolio. ETFs or single stocks, better play? I think personally, I would prefer to go into stock pick, because I am in the industry. I look at the market a lot, because when you look at ETF, what it does is that it invests in all the entire market. So for example, if you're investing in the entire S&P 500, so that's what it does, right? Which is good to a certain extent. It allows you to diversify entirely to the 500 stocks. But the downside to it is that within that 500 stocks, there are companies that might not do well, right? So when you invest just on ETFs alone, you are not able to filter that through. So personally, I would prefer stock pick. But again, like I said, it's probably depends on whether you have the time to filter out all these individual stocks on a more detailed manner, right? If you don't have the time to do so, probably it's best to go into ETF. I think the best example that I can give you is during the global financial crisis, when the subprime crisis in US in 2007, 2008, right? So back then, everyone invests in this tool called MBS. What they do is that they actually pull together all the mortgage loan together, and then they give it a rating, right? So when you pull together too much mortgage, you combine your AAA ratings as well as those who are not doing so well together into a pool of funds. So it's very hard for individual investors to really look at what is good and what is bad. So this is probably some of the downside to it. So ETF has always been a topic that people talk about, whether they will create a systemic risk, as in if the market were to fall, how would that affect the entire ecosystem for the financial industry, right? So that's always been a risk when people talk about ETFs on that front. Now, so what if market crash? I think it goes back in line with this. I mean, I talk about the probable risk of investing in ETF, right? So what if market crash, right? So that's the point of this year and long-term investing. Because even though if the market crash, there is always a buying opportunity. So if you can see from the images here, this is how I am just simplifying it, right? So when you see the market crash, there's always the recovery to it. So the question is always, how long will it take to recover, right? So I think the longest bear market that we have is in the GFC period. So back then, I think it was about 18 months of the bear market, but of the recession. But it's not just the recession itself, right? 18 months recession, and I think it takes about 3 to 4 years, 3 to 5 years, I guess, before market actually recovered back to its previous high. So what it means is that 5 years plus another 2 to 3 years, it probably take about 6 to 7 years before the market recovered to its level prior to the crash. So assuming if you buy right just before the crash, right, that means that you would have suffered a lot of losses. But if you're consistently investing over the next 6, 7 years, you actually buy at a discount before the market recover. Because if you look at the longer term trend, like for example, the last 10 years that we have, the S&P 500 return is more than 10% and on annual basis, right? So that's a very good return. But it's not just the S&P 500. It works across a lot of different markets, whether it's in the STI, whether it's in the NASDAQ, or whether it's in the Europe market. Of course, various different markets have different returns. It depends on the market condition. But in the long term, when you invest in the stock market, you tend to build up or you tend to beat inflation and beat the market in an overall basis. So now we will talk about the easy strategy, right? So it's basically trying to free you from all these hassles. Now, I'm just going to be a bit more practical on how it works. So basically, my own advice is to invest more on rather than on a monthly basis, to do it on a half yearly basis. Well, my reasoning is very simple, because sometimes when the market crash, it doesn't always crash in a very quick. Like, for example, COVID was a time where the market was down by 20 to 30%, right? So that's when you will make a lot of money if you buy the dip, right? So if you invest on a regular basis, on a monthly basis, it will help you. But if you look at the market in, say, in the global financial crisis, because it's a long recession period, and then the bear market is longer. So when you buy the dip on a monthly basis, you will actually be a bit more, you will probably feel a bit more nervous and panic, because the market swings are more volatile and the decline are deeper and longer period. So you'll probably be a bit more frustrated. So if you space out to a longer period, it actually makes it easier for you to manage the emotion portion. But just for simplicity's sake, you could actually start it by about $50 to $100 per month, depending on your budget. I think the lowest at Boost, the Save Up platform that we have in Malaysia, I think it's about 10 ringgit, I guess. Yeah, so it's only at around that level so that you can start. So you can actually pick an ETF or index fund that you want to, and then automate it with an RSP. Then you basically just allow it to do to allow the market to do its work rather than trying to figure out what's the best way to time the market, right? So it's not the timing in the market is about, but it's about the time that you have in the market. So the next thing is basically, I think the best advice is the best time to invest is today, right? Sorry, the best time to invest is yesterday, right? The second best time to do so is today. So the idea is don't procrastinate, start doing it today, because the idea is that the longer you are in the market, the more that you are likely to make return as compared to when you try to time the market. So choose a right platform that you have, right? Whether you want to start with us at Up, or you wanted to look at other brokers that you're probably more interested in. I would suggest to start with those that are low cost index ETF. Like I said, the best benefit for ETF is really the cost. The cost is at a very low level at about 0.1%. If you compare that to other markets, like if you invest into funds, then the active funds managers will probably charge a lot more. Then set up an auto debit and then maybe check back every year. Then you can actually reposition your portfolio on a yearly basis. But let's just keep it real, right? I think that we need to be realistic. I think everyone has a different understanding and wanted to know how, it's easy for us to talk about that, but the market swing. So you wanted to know what happened in the market. So let's just talk about what happened in 2025. Let's talk about what happened to the stock market at the start of the year and how it has swung, right? So I'm just going to give you a brief overview on how the market has moved in the US market as well as in the ASEAN market. So if you look at the first 2 months of the year, there was a lot of positive momentum in the stock market. Those who forgot, Trump became the president, I think, end of last year. And then after he won president, I think there was quite a bit of momentum. The market was quite bullish because Trump did talk about a tax cut, deregulation, a lot of things that are positive for businesses on their front. And the market are focusing a lot more on that because everyone believe that, the perception is that Trump is a businessman, so he will not do things that will harm the economy. So that's where the market has seen a strong rally. And of course, the strong earnings also help. So this allow the market to kick off in a very strong momentum at the start of the year. Then when it comes to March, there's a start to have a lot more concern because Trump has talked a lot more about tariffs, and there's a lot more talks about cuts in terms of spending. At that time, I'm not sure how many of you followed. Elon Musk was leading the DOGE, Department of Government Efficiency in US. So there's a lot of hype on that. So there was a lot of concern. So that's when you see a lot more profit-taking activities in the United States. So this is why if you look at this year, it's very rare that the US done worse off than some of the in other developed markets. But this is one of the year that the US has underperformed most markets during the first half of this year. So prior to this, there's always this talk about the US exceptionalism, meaning the US is seen as a better market or market with premium. But this year, there is a concern that story is going to end with so much uncertainties in US politics, as well as how Trump run the country, right? And then of course in April, when Trump announced the tariff on April 2nd, there is a shock in the market because the tariff was way higher than what was expected. I think some countries got about 30%, 50%. So things become a bit more concerned. But of course, we saw a gradual recovery in the second half of the month itself because after that, Trump retracted and then he said, all right, maybe we don't do the tariffs now, then we will allow that for market talks to negotiate on the tariff. So if you look at it, you can see that the market do swing up and down based on what's happening in the market, whether it's in politics, whether it's in earnings. So those are things that will drive markets as well as in policies, right? So then May to June, markets continue to recover. In fact, the Nasdaq and S&P 500 closed June at near record level highs, right? So these are some of the things that drive the market. So tariffs have helped to when tariffs are put to a halt, it actually helps trade negotiations. So things have recovered. Then there is also the cooling inflation. So US inflation has slowed down significantly. So there is a belief that the US Fed will eventually cut rate in the second half of the year. So when the US Fed were to cut rate, this is actually positive for the stock market. So you can see that happening. Then of course, the AI and big tech has continued to lead the market rally. So if you can see some of the earnings, if you've been following, you notice that a lot of the tech companies, especially those that have a strong AI presence, have done exceedingly well. So I just written a report on Microsoft in terms of their earnings as well. So these are things that will really move the market going forward. So we've seen the momentum led by companies like Nvidia, Microsoft, Meta, and Apple. So just a bit of warning signs for investors who are overly optimistic on the market is that the margin debt, especially in trading, have actually surged in April to June period, meaning that there's a lot more risk-taking activities in the market. So there might be a bit of overheating. So it's probably important for you to be a bit more cautious in your trade activities or when you place your position for the AIC challenge, right? Now, in the ASEAN market, it's a bit more diverse because ASEAN, while they are a block together, they are quite different in terms of their business, in terms of the fundamentals, in terms of the strength, even in terms of their policy and politics. So for Singapore, there is a strong first half of the year. Financial and industries has remained steady, supported by strong balance sheets and regional inflows. So if you're investing in the second half of this year or for your AIC challenge, one of the things that you must take note of is because Singapore has this new funds that they're gonna pump into the stock market through some of the fund managers that are selected. So this will actually boost liquidity. So you should see a lot more activities in the Singapore stock market. So do look out for the Singapore market and catch some of the bigger names, some of the stronger names that they have. Now, for the Malaysian market, they have actually underperformed in the first half. In fact, Malaysian and the Thai market was one of the few markets that were in the red during the first half of this year. This is mainly due to foreign fund selling. We do expect there to be a gradual recovery in the second half of the year as rate cuts are likely to revive the investor sentiment, right? But there is a bit of concern in terms of how the trade tariff will affect the Malaysian market. I think until today, Malaysia has not been able to negotiate a deal with US, but there was news today that Trump has a phone call with Prime Minister Anwar Ibrahim. So that might be some positive news might be coming out from that, right? So you have to take a backseat and see how this pans out. Now, in terms of the Indonesia market, is basically quite stable, and then consumer demand has continued to drive the market a bit. So we've still seen quite a bit of positive momentum in the Indonesian market. Philippines is rather flat, but it remains an attractive region for investors who are looking for growth. Now, Thailand has underperformed in the first half, mainly due to political uncertainties, weak earnings, and persistent foreign outflows. I think we will still see that happening in terms of the concerns over the political stability in Thailand, right? But I think the Thailand market do offer some attractive valuation point of entry for investors and traders. So if you look at the Thai market, I think prior to last week before that, there has actually seen quite a bit of recovery. It's just that I think because of the Thailand and Cambodia border crisis, so the Thai market has then retracted a bit. So the lessons from this is basically what I want you to know is that if you look at the market movement swings, you can see that US markets have rebounded despite the panic in April, right? So if you have been using the DCA strategy, you would have benefited from it because you buy through the dip, right? And then of course, if you look at ASEAN market, it has shown a clear divergence. Some markets are doing better than the rest. For example, Singapore is doing very well this year. Indonesia is doing relatively well. Well, for example, the likes of Malaysia and Thailand has not done as well during the first half of the year. So if you use ETF to invest in, say, a certain region, a certain specific location, then you benefit from this diversification that you have through ETF investing. And then, of course, you allow volatility to work for you instead of trying to time the market, which is good if you can time the market all the time, right? If you can always buy the low, and then sell at the high, then it's good for you. But I'll be very honest with you, and this is a true story, right? It's across the market, across industries. Even the professionals are not going to do very well if they were to try to time the market on a short-term basis, on a very frequent basis. So what I'm trying to tell you is that history has shown us that it's difficult to time the market, to beat the market on that basis. So try to let that volatility in the market to benefit you rather to try to challenge it, right? So by one of the ways and the easy way to do it is to invest through it consistently. Now, I'm gonna give you the bonus round. So I think I forgot to mention at the start of the session. Today's session will be a bit shorter than the rest because it's a bit more on how to automate your investing. But I do want to give a bit of tactical strategy in terms of how you want to invest in this current market. Basically, this is just to suit those who are looking at it from the AIC challenge perspective, because this challenge is on a short-term period, right? So that you know what to look out for during this in this near term. Now, from a global market context, I think you need to know that the US market have actually regained momentum. I think there is a lot of positivity in the market at this point. The Nasdaq Composite is back to its record highs, and then there is a strong rally thanks to the big tech as well as the AI. So if you ask me, when you look at the earnings season, a lot of the companies, especially on the tech side, has reported strong earnings, and their guidance going forward is also quite positive. I think they are looking at the sustainable recovery in terms of earnings. I think this is what I talked about earlier, that this is a structural growth story for the industry as a whole. Because if you look at it, a lot of companies will start implementing artificial intelligence into their system. So companies that build the infrastructure for this growth level will benefit from it first. So when I talk about infrastructure building, it means things like your NVIDIA, your TSMC, the chip makers. So they will be the first to benefit from it. Then it will be a second layer, which is the likes of your software companies, your AI solutions like Microsoft, OpenAI, the likes. But of course, OpenAI is a private company. So these companies will then benefit from it because you will see a lot of demand on that front, right? So we are looking at a structural difference. So it's the rally that we're seeing is quite different from what we've seen during the dot-com bust in 1999 era, right? Back then, a lot of the tech companies or the internet companies were not making money. Today, these tech companies are making money. So yes, valuation is on a slightly high side. I think valuation for Microsoft is what, about 30 plus times their PE. So it's rather high as compared to the historical average as well. But there is a story behind it, and that story is that growth engine remains strong and resilient. So then, of course, your ASEAN market has remained resilient. I think despite a lot of the uncertainty revolving around tariff, ASEAN market has done relatively well. I think this is mainly because a lot of the ASEAN market is also supported by domestic consumption, domestic demand. And then there's also a lot more policy stability. So for example, Malaysia has been a lot more stable now as compared to what it was, I think probably 5 or 6 years ago. So there's a lot more stability on that front in terms of policy. I think Malaysia is announcing their 13 Malaysian plan, right? So today, so there will be some things to take note from there in terms of how this will drive the shift in terms of government focus policies, and how this will actually affect businesses that are listed on the stock exchange. Then, of course, the regional integration. We've seen a lot of cross connectivity between Singapore as well as other markets. So these are some of the things that are happening on a global context, so that you understand which markets will benefit you better, right? Right, just to put it simply, right? So these are just some easy ways to play with it. So for those who are looking at the Nasdaq, I'm talking about Nasdaq because the IC challenge has that, or the US market. So if you're looking at using the easy way to invest. So one way to do it is to start off a small allocation through your ETFs like your QQQ. QQQ basically invests in the Nasdaq index, right? Or the S&P 500 index funds. So this way you don't have to spend time trying to monitor the market. So one best way to do it is to allocate certain percentage for the Nasdaq, which is for your growth companies, and then another one is for the S&P 500, which is for the biggest 500 companies in US. But if you do that, then all your exposure will just be in US, right? So if you wanted to expose yourself in other markets, then you probably need to look at ETFs that invest in different markets, different countries. So for tactical trades, means for those who are more short-term and trying to ride the momentum, this is especially important for the AIC challenge. What you can do is basically use momentum and earning catalysts to time the entries in big tech stocks. So for example, if you are expecting, I think tonight the earnings that will be reported are NVIDIA. I think one of them is NVIDIA. So if you expect earnings to be very strong, one way to do it is to buy ahead of it. So then allowing momentum to take that trade to go up, right? So these are all very tactical strategies, but before you do that, you do have to look at your resistance level, your support level, to really have a clear strategy on how you want to trade this market. So consider protective hedges, basically looking at things that can hedge if, let's say, your calls are wrong. So for example, if you think that for example, before Tesla announced their results, right? If you expect Tesla were to do well, right? And then you were to invest heavily in Tesla, then it would be a wrong strategy. I guess just now we have a comment that says that they'll go all in on the gold spot, right? But if you do that, then if let's say you were to get it wrong, then you will lose out. Say example, if the market were to down by 30%, you have lost 30%. And I think at earlier stage when we talk about it, if you don't increase your investment, in order to break even that losses of 30%, you need to make an investment that generate a return of 60% in order to you to just break even. So basically, you need to double your winnings in order to just to break even back at a level, right? So especially for very short period of time, such as the 2-3 months period, like the ones that you have for the AIC challenge. So you need to be able to have some of this protection in place to help you to navigate, right? So another one, if you look at ASEAN market, I think the easy way to really do it is really to use this year to just invest into ASEAN ETFs or buy market. So there is a ETF for your STI, there's also ETF for your FBMK LCI, there's ETF for your various leading benchmark markets, right? So just use that to invest into the markets that you're more familiar, that you're more comfortable with, and then regularly investing in it. Then this way you can actually build your portfolio in both ASEAN market as well as in the US market. Well, it's important to have that portfolio or the allocation in ASEAN market. I personally think it's because ASEAN is a growing region, and there's a lot of growth that's going to come from ASEAN because of the population size, because of the emerging middle class. So these are all very important structural issues that will drive your ASEAN market in the longer term basis. So I do think it's important for investors to actually position themselves in such a way, right? For those who are looking at tactical, basically for the short term, I think Malaysia, Singapore, and Indonesia, it's a market that you can actually overweight based on some of the more favorable macro momentum and policy tailwind. So for example, in the Malaysian market, if you're expecting there to be a trade deal between US and Malaysia tomorrow, then it's probably good to position some of it at some of the biggest companies in Malaysian market. So these are some of the tactical strategies that you can look at, right? Basically investing ahead in terms of what you expect the market to place out, right? But again, always do it with your concern in terms of your protection on the downside, right? And then, of course, you can always rotate out of the weak performers like Thailand, right? But do take advantage of the technical rebound because, like I said, Thailand do offers that value in terms of valuation. I think the reason why the Thai market is on at such a level is because there's a lot of uncertainty on the political front. So, of course, if you're in Thailand, so you're probably more familiar with the political situation in Thailand and how it is developing. For those who are not in Thailand, you're probably relying on news flow that are probably secondary. So you might receive news that are later. So it's important for you to take that into consideration, especially on tactical plays such as this. Now, some tactical play ideas. Probably talk about Nasdaq teams. So one of it is, like I said, AI's growth story is a structural growth story. So we do think that this growth that we are seeing will continue. So the likes of Nvidia, Microsoft, and Meta are likely to continue to perform in terms of their earnings. And if you look at their guidance so far, has been quite positive. I think we will know about Nvidia later today. And then do watch out for technical breakouts and momentum continuation into the third quarter and the fourth quarter. So this is quite important because momentum can change, right? So for example, August 1st is tomorrow. So the market might change in terms of how they see it because the tariff deadline is there. So people probably want to know how that impact will affect the overall stock market. So that's when you probably wanted to slow down your trading activities and take a pause and see what's happening, what's developing before you decide to make your trade. So do look out for some of these technical breakouts and momentum that might be happening over the next 2 months, especially for I think the next 2 months, especially if you are looking at the AIC, the ASEAN Investment Challenge. Then use momentum-based models or option strategies to add a more risk control exposure. So options are a bit more for sophisticated investors. So probably look at momentum-based models that can help you to set certain stop loss level that can allow you to continue to trade throughout this period of the challenge, right? At CGS, we do provide technical outlooks on a daily basis for various markets, whether it's Indonesia, whether it's in Thailand, whether it's in Singapore, Malaysia, Hong Kong, or US. So you are able to get all this from our research, right? So you are able to leverage on some of these things for your trade. For those who are looking at the ASEAN market, if you're more interested in the ASEAN market, so for Malaysia and Indonesia, I think rate sensitive sectors will benefit from it. So, and then of course your strong export and infrastructure spending will be a key. I think some of the exporters have not done so well at the start of the year in the first half, mainly due to concerns on how tariffs will affect them. I think as we have more clarity, whether it's 10%, whether it's 15% tariff, or whether it's 25% tariff, markets will recover, because I do think that most businesses will be able to adjust their business model as well as their strategy as there are more clarity on the policy front, right? For Singapore, your financial industry is likely to continue to do well. I think it's important to build that portfolio up, to build that foundation, right? Because the Singapore banks are not just local champions, they are regional champions. So they do have a lot of presence in ASEAN as well. So they have a strong presence in some of these fast growth economies. So they will benefit from it. Of course, in a recession, they might be affected if, let's say, there is a recession because of their exposure to these markets as well. Then we do expect to see some recovery in the REITs market, especially if there's a rate cut in the US. In the second half, I think there's a lot of talks that rate cut might happen in September. So we will have to wait and see whether that's going to materialize. But the market is having high expectations that will materialize. Then, of course, your tech infrastructure will also benefit. I think basically on the cap market liquidity that I talked about. So these companies will really benefit from it because when the MAS were to inject some of this liquidity into the market, the idea is really to invest or to allow more exposure into companies that are within the mid cap space. Basically, companies that are not too large in terms of size, right? But in the mid cap range. So some of these companies will benefit from it with more exposure to investors. Then, of course, Philippines are really more on domestic consumption. So look at some of the domestic names that I talked about at the start of I think at the first session, I do have it. So you can actually go back to our live session at your YouTube, then you can actually go through some of the lists that I've given you, right? So there is also that opportunities there. I would say avoid overweight in Thailand, but I think that you should look at it for tactical rebound opportunities. So don't overweight, don't buy too much into it, but do have a bit of allocation that will benefit from some of the recovery or rebound in the market. Because when there's a rebound, usually the swing is slightly higher than the usual recovery that we are seeing. Right, so just a bit of tactical notes for those who are in the challenge, right? The idea is that the views should be rotational, not static. Basically, what it means is that if you are in this challenge, you should think of how you can maximize or trade and take advantage of some of the moving market developments. So, for example, earning surprises, central bank moves that I talk about in US Fed, and of course your tariff developments. So these are three keys that you can look at for now, right? There can be more. So for example, domestic development are also important for your various countries. So for example, the 13 Malaysia plan will probably be very important for those who are investing in the Malaysian market. So things that you can actually keep an eye on which sector will benefit from it, right? Then of course, use momentum signals to help you to make that trades, right? Don't go in without a trade strategy, especially don't go in without exit strategy. So I think it's very important, because if the market were to tank or to see a sharp correction, you must be able to have a level-headed to make that trade decision, right? So do maintain your easy peasy or easy way or investing base as in parallel with the trade strategy that I talk about, because it should complement one another, right? So the idea is that I think more importantly for your longer term investing, once this challenge is over, is that you will be able to use this way to build up your portfolio to start investing, rather than stay idle and wait on the sideline. So a lot of people stay on the sideline and wait until market correct in a level that then they can benefit from the crash. So the other day I had this talk with one of the media, and we talk about what if recessions happen and what's the biggest mistake. And I think the biggest mistake that anyone can make is to wait on the sideline, right? A lot of times when the market crash, people will say, okay, maybe it will go down further, right? So it's a bit risky to trade now. When the market is too high, you will felt that, oh, it's actually too expensive now. Probably it's too late already to go into it. So there will always be that perception, because at every point in time, no one, if you're looking at it on real time basis, you will not be able to know when it is the peak or when it is the bottom. So at every point, at every turn, it will felt like it is the bottom or it is the peak. So the idea is that you wanted to eliminate all this distraction and get your investing started, right? Okay, I think that's it for today. And like I said, today will be shorter because I think we do have. So if you have any questions, feel free to write in to us. You can also, I think you can ask us on social or even email to us, and I think we will have a team to respond.